Hey there everyone, are you ready to unlock the secrets of smart investing, even when times are tough? Imagine turning a challenging economy into your golden opportunity. Today we're diving into the world of Warren Buffett, the mastermind of investing, to share some game-changing strategies that can help you thrive in 2024 and beyond. We're not just talking theory, we're revealing real, actionable tips that could transform your financial future. Stay with us until the end to discover how you can make wise investment choices, safeguard your money, and maybe even find some golden opportunities in unexpected places. This isn't just another financial talk, it's your roadmap to thriving in any economic climate. Subscribe to my channel and stay till the end. Warren Buffett, a big star in the money world, leads a super successful company called Berkshire Hathaway. He's been in charge since 1965, and guess what? Under his leadership, the company's stocks have skyrocketed, growing by 20.1% annually on average. That's almost twice as fast as the usual market. To put it in perspective, Berkshire's growth is a whopping 3.6 million, way ahead of the typical 30,000. Now, let's talk about Warren's advice. He believes stocks are great for the long run, but a bit risky for the short term. We'll dive into his smart tips, especially for the challenging times expected in 2024. But first, let's get a sense of what's on the horizon. Jim Masterzo, who manages a massive $130 billion, warns that the US might face tough times soon. There's chatter about a recession that's lingering. Despite a strong economy and low unemployment, Forbes warns of a possible recession by late 2023 or 2024. Remember the aftermath of the big financial crisis? Average Americans saw their wealth grow thanks to two key moves. The Federal Reserve slashed interest rates during the 2008-2009 crisis and did it again during the pandemic. These rates stayed super low, almost zero from 2010 to early 2022. Then there's the government's massive spending. It was already more than inflation from 2012 to 2019, but it soared during COVID. The spending leaped from $4.45 trillion in 2019 to $6.82 trillion in 2021. That's a 53% increase in just 2 years. In 2023, the plan was to spend $6.35 trillion, slightly less than the peak, but still much higher than pre-COVID levels. All this, the low interest rates and huge government spending, injected loads of money into the economy. Now, as we move away from this phase, people are worried. The American economy in 2023 showed us some crucial lessons. So despite fears of slow growth or even a recession due to the challenge of reducing inflation, the US did quite well. The economy grew by about 2% annually, and inflation began to decrease. But here's the thing about recessions. They're not just about slow growth. They often lead to more job losses, fewer job openings, and the government needs to step in with extra financial support and benefits to the unemployed. During economic downturns, investors often find themselves at a crossroads. Should they hold on to their cash or invest in something promising for the future? In a recession, stock values usually drop, and this can be a real headache for those with investments in stocks. But what if this is actually a golden opportunity to make money? Warren Buffett sees a silver lining when stock prices fall. He's been investing in stocks since he was 11 years old, so for him, a drop in stock prices is like a big sale. It's like getting your favorite burger at a discount or finding Coca-Cola for a cheaper price. Warren's approach is useful for all kinds of investors. If you're under 55 and aiming to build your wealth, a falling stock market might actually benefit you, as you're likely buying more than selling. But for those over 70, a stable or rising market might be preferable, since they might be selling more than buying. Regardless of your age, it's common to react emotionally to a falling stock market. It feels safer to buy stocks when their prices are climbing, but the best time to buy is actually when the market is down. Imagine your favorite item is 50% off. You'd probably grab it, right? The same principle applies to stocks in a down market. Don't be afraid to buy when prices are low. For long-term investors, a market drop should be a cause for excitement, not fear. There's this inspiring video of Warren Buffett talking about his early days in investing. Initially, he thought predicting stock prices was crucial, but then, around 19 or 20 years old, after reading Ben Graham's work, he realized he was mistaken. Even in a recession, adopting Warren Buffett's forward-thinking approach is wise. He famously said in 2008 that you should be fearful when others are greedy and greedy when others are fearful. So when others are feeling jittery about investing, like during a recession, that's your moment to snap up stocks and other investments at lower prices. Buffett puts it this way: bad news for the economy can be good news for investors. It's like grabbing a piece of America's future at a bargain price. This wisdom is just as relevant today as it was during the big recession 15 years ago. Here's a key point: don't try to predict when the economy or stock market will bounce back. Even experts like Buffett avoid this. He believes some people just aren't cut out for stock ownership because they panic when prices fluctuate. If you sell off your stocks in a panic when their value dips, it's not a smart move. It's like if someone underbids for your house. You wouldn't sell it just based on that low offer. But stocks can make some people too anxious. Buffett offers some advice for investing during times of high inflation. He suggests the best defense is to be the best at your job. Most people don't fully tap into their potential, and for easy investing passively, he recommends owning a part of a solid business. If you're part of a strong business, your purchasing power is likely to stay steady even when money's value shifts. Here are the essentials. In times of high inflation, sharpen your skills. This makes you more valuable to your current or future employers, helping your salary keep pace with rising costs. Buffett also advises that a smart, low-effort investment strategy is to stick with a robust business. Buffett elaborated on this in a 1981 letter to his shareholders. He said that businesses that thrive during inflation have two key traits. First, they can raise prices easily without losing much business. Second, they can handle increased sales, often due to inflation, without major additional costs. This means businesses that can expand easily fare better during inflationary times. Take a tech company like Instagram, for instance. Adding another ad costs them little, but for big car manufacturers like General Motors or Toyota, ramping up production by 50% means significant additional costs and time. It's much harder for them to scale up quickly. Let's circle back to Warren Buffett's insight on investing when prices are on the rise. He says the smartest investment is in companies that can up their prices without losing customers. This indicates they offer something special. Buffett is a big fan of Apple for this reason. He even thinks it's a better investment than their railroad business. Buffett highlights Apple's significant role in people's lives. An iPhone can cost as much as $1,500, similar to a second car. But given a choice, many would stick with their iPhone over a second car. This shows just how unique Apple is. Apple's appeal isn't just about the iPhone, it's about entering an ecosystem where all Apple products, like TVs, MacBooks, iPads, work seamlessly together. This keeps customers loyal and constantly upgrading. iPhones have also become a status symbol, with people often buying the latest models to stay trendy. This brings us to the concept of moats during inflation. Moats are unique strengths that help businesses stay ahead. It could be a patent, a famous brand like Coca-Cola, or a commitment to the best prices, like Costco. These advantages allow companies to maintain high prices, even when costs rise or profits shrink due to inflation. Companies with strong moats can thrive in inflation because they can hike prices without significant drops in sales. Consider MasterCard's success. Their advantage lies in their massive digital payment network, with 3.3 billion cards and countless retailers. This network is tough to replicate. MasterCard earns a bit from each transaction, and with $8.2 trillion flowing through their system in 2022, those bits added up to $10.1 billion. MasterCard is great against inflation because, as prices rise, so does their transaction revenue. Plus, their future looks bright as the world shifts from cash to cards. Now, about those high interest rates and the 2024 economy. Buffett sees interest rates as gravity for asset values. They have a significant impact on their worth. This section focuses on how interest rates impact money and businesses. Low interest rates make borrowing money cheap and easy, leading to more spending and growth, as we've seen in the past decade. But now, with rising interest rates, borrowing is getting more expensive. This is hard on businesses. Paying off debts is tougher, and people have less to spend. This shift significantly affects business performance, which reflects in their financial results and stock prices. Over the last 5 years, we've seen a pattern. When interest rates rise, stock markets often struggle. For instance, in 2018, higher rates meant little change in the stock market. In 2019, rates dropped and the market rose. The Federal Reserve set rates to nearly zero during COVID, and the market soared for 2 years. But in 2022, with a sharp increase in rates, the stock market fell by 20%. This trend suggests that higher interest rates usually mean tougher times for stocks. It's often because businesses aren't doing well, which lowers their stock values. Also, interest rates influence government bonds like US Treasury bills. These bonds are very safe, and changes in interest rates affect how investors behave. For stock market investors, thinking long-term is key. Lower prices of solid businesses can be great opportunities for lasting gains. We cannot control the Federal Reserve, so the strategy is to focus on the long game. Look for chances to invest in strong businesses at good prices, especially when interest rates are high. Here are 3 essential tips to safeguard your money, even with Warren Buffett's smart investing strategies for 2024. 1. Build emergency savings. Aim to have enough saved to cover 3 to 6 months of living expenses in case of a recession. It's safer to have about 6 months' worth. Set up this emergency fund before you start investing. 2. Stay invested for at least 7 years. Investing during economic downturns is challenging. You might buy stocks thinking they're cheap, but their value could drop soon after. To avoid losses and eventually profit, think long-term, just like Warren Buffett. 3. Resist constantly checking your portfolio. When the economy and stock market are unstable, it's tempting to check your investments all the time. But try not to do this. Checking too often can make you panic and sell your stocks too quickly, which usually isn't a good idea. This video is for educational purposes. Always research and consult experts before investing. If you enjoyed this, check out our next video, subscribe, and share your thoughts in the comments. Thanks for watching, and see you in the next video. Here's to your investing success. Profitable investing.